Hey, what's up guys, welcome back to the channel. In today's video I'll be going over some extremely important day trading rules that new and even some experienced traders tend to miss whenever they're riding momentum trades or even scalping a high flying stock. Outside of all the fancy indicators and candlestick patterns, there are some crucial psychological and very simple support and resistance tactics you can also apply if you want to increase your win rate during day trades and become at least somewhat profitable. And those tips and strategies are exactly what I'll be discussing in this video. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. The first strategy I'm going to talk about in this video is something I like to call the pre-market range. You see, whenever a stock has news very early in the morning, well before market open, you'll often see the price action form a range of support at the bottom and resistance at the top. Ideally, this will give you the opportunity to buy or anticipate the breakout from the pre-market high level or potentially buy the dip for a quick bounce play from the pre-market low. Lots of inconsistent traders tend to struggle primarily because they don't know what levels to really play off of. Instead, they will focus on the popular indicators like the MACD or the RSI, which unfortunately have a very low win rate when it comes to day trading. Here's a look at an example to really illustrate my point here. As you can see, we have the ticker symbol SPRT that ran up on news on around August 23rd. We ended up consolidating into the after hours, and then at 4 a.m. we gapped up a little bit. As you can see here, we went sideways all the way up till around 8 a.m. in the morning Eastern Standard Time until we got serious volume. As you can see, the price action ended up going and testing the resistance we had made the prior day, and instead it just kind of consolidated sideways and was not really able to get above that level until after the market opens. And this is exactly what I would call a pre-market range. You have this bottom support level that was formed right after the 7 a.m. burst where TD Ameritrade and also some other brokerages actually opened up for their extended hours. We had a little bit of a dip. We found some support because we got some volume coming in. And that tells me that this is generally an area where buyers are going to step in. And the same thing goes for up here, which is where sellers will essentially start stepping in because we were not able to break this high and we kind of consolidated sideways. So when it comes to market open, which is when I recommend most retail traders trade, we will have a good opportunity to eye these support levels and potentially buy the dip or play the breakout. And as you can see here on SPRT, this played out very, very nicely. As you can see, we had a nice dip at the market open on the 5-minute candle. We found a little bit of support around this $10.87 region, but if you look at the candle itself, you can see we had a doji, which means that there's a big indecision in the market and there's no clear direction, right? The buyers are not in control, neither are the sellers. There's essentially an equilibrium. We dipped, we ripped, and then we came back down to that opening price and ended up closing right around there. But then what ended up happening is we had this very nice squeeze for the shorts who ended up shorting the price action up here. And as we all know, whenever a resistance level is broken out, it becomes very strong support. And as you can see, that's exactly what happened here. The people that ended up missing the initial breakout move are able to buy and backtest this level for another squeeze higher to $14. Here's another good example of that same exact concept, but on the short side this time with ticker symbol BBIG. As you can see today on market open, we had a huge dump and they basically triggered all the stop losses and they did a huge stop loss raid, which as you can see ended up trading with a lot of volume right after market open. And the main reason for why this happened is, again, they broke the pre-market low, which was right around $6.65. As you can see in after hours yesterday night, we had a nice low here. And then right before the market opened, we also had a very nice low formed here from which we had this very nice bullish candle, which as you can obviously see ended up being a fake out. And this is exactly why you want to chart out these levels as soon as you see them, especially with levels where you have multiple levels coinciding. As you can see for this level, we had one bounce, 2 bounces, 3 bounces, and a 4th bounce right here, which means that this level is going to have a lot of stop losses underneath it. And if we break it below that, we're going to have a lot of selling pressure and the tape is going to accelerate very, very fast. And if you were a short trader, you could have entered on the close of this 5-minute candle right below that level. And as you can see, you would have gotten a very nice flush. And even on this back test, you could have gotten a very nice run. Now, for those days where you might not have a very clear pre-market range settled out, or if you're just not confident enough that these levels are going to hold because of low liquidity in pre-market or something like that, you can always go down to the daily time frame for whatever stock you're trading and chart out the resistance levels by scrolling left on the chart. And here's a good example of what exactly I mean by having a look at ticker symbol SONN, which was a runner we had twice in the past 2 weeks. If we completely ignore the high volume action we've seen over the past 5 to 7 days, you can see we have some very clear support and even resistance levels on this chart, but particularly resistance levels because as you can see, the stock has been in an extremely strong downtrend ever since the start of the year. As you can see, for this 2 to 3 month period in early summer, this stock really had a very hard time getting above this 1.63 to 1.66 zone, which is why this is marked as an important resistance. And as you can also see, we had a very nice gap, which is another resistance level I can also chart on the stock, because whenever we have a huge gap down like we saw here, we will always have a gap fill all the way to the closing price of the previous candle. And this is typically very easily done because this gap is essentially extended market trading. And extended market trading, like I said, has much lower volume when compared to the actual market open, which is why it's very easy for price action to kind of move through those levels. And that is exactly why I would chart this out as a very strong resistance level. So once you have these levels charted out on your chart, you want to go back to the intraday time frame and use these as areas for breakouts and also short selling if you're into that. This gap resistance level ended up performing extremely well, as that is exactly what the high of day was for that specific trading day. And this is exactly why I always recommend go zoom out and look left on the chart to see where exactly the key levels are, draw them out through either the pre-market range or even the daily time frame like I've just shown you guys, and use those as levels you want to day trade against for either breakouts or buying the dip opportunities. Now moving on to the second strategy for entering day trades properly, and this one is actually using a couple of indicators that I find extremely useful, and they tend to work very well together on the 5-minute time frame, as you can see on the chart. What we're using here is the VWAP and an exponential moving average as buying points after a stock has either broken out or if there's a continued momentum run that is taking place. These indicators could act as extremely good buying areas if you want to buy on the pullback and sell on the rip. Normally, the biggest reason why so many day traders lose money is because they're afraid to buy when the stock is temporarily in the red, but they love chasing it when the stock is back into the green and is tearing up. But this is the exact opposite of what you're actually supposed to do in the markets. If we're long bias, we should be buying the panic pullbacks to these support zones that could either be support levels on the chart like I've just showed you guys, or they could also be indicators like the VWAP or any moving average. For this example, I am using the 20 exponential moving average, which in my experience works extremely well, especially on the 5-minute time frame. But let's start off with the VWAP first, which is probably one of the most talked about and used indicators in the entire industry. The rule of thumb I have is whenever the stock is trading above the VWAP, you always want to be long bias, and if the stock is trading below the VWAP, you don't want to touch it if you are long bias. Because what that essentially means is that when the stock is below VWAP, there isn't a lot of buying pressure that is pushing up the share price, and there's likely not a lot of momentum to the upside, which is why if you do want to buy a pullback in an uptrend, you will not get that good opportunity if the stock is trading underneath the VWAP, kind of like what's happening here. As you can see, after market open, SBRT ended up just selling off and it traded below the VWAP, and it ended up testing this resistance level right around the VWAP and ended up getting rejected. Ideally, what you want to do is you want to wait for a continued and a sustained breakout above the VWAP before you trade long, especially later in the day, because later in the days is when we have real momentum coming back into the stock, whereas in the middle of the day, we have very low volume. As you can see, we have a similar story here with SBRT on August 26th, where we had a very nice market open flush to the upside. We had a pullback right below VWAP, which ended up trapping a lot of longs, and a lot of short sellers took advantage of this. And this is also one of the reasons why you can always use the VWAP as your stop loss if you are long biased. For example, if you ended up buying the pullback here for this very nice flag pattern and you rode this all the way up here, but you're really looking for a continued move to the upside, you can always set your stop loss a couple of points underneath the VWAP so that if the stock ends up closing below the VWAP, you don't get caught up in a move like this and give back all your profits. And like I said, you always want to wait for a breakout above the VWAP, and that's exactly what we have seen here. We had a very nice ascending triangle right under the VWAP, and we had this very nice breakout with a lot of volume on the candle with a very nice wide body candle, and this is exactly the trade you want to take. And as you can see, ever since the stock ended up trading above the VWAP, we've been in a very strong uptrend, and we had an extremely strong close for which you could have bought all these pullbacks and made a lot of money. And this is exactly where the 20 EMA comes in extremely handy. For whenever the price action is trading above the VWAP, I recommend using an exponential moving average on the 5-minute time frame, in this case the 20 EMA, as your pullback area entry zone. As you can see, we had 2 respected zones here, followed by a lot of respected zones in after hours. And as you can see, this stock ended up continuing extremely high, and you would have got a stopped out for a hefty profit right around this $28 region if you had used this 20 EMA as your trailing stop loss. And now moving on to the third and last strategy, which is going to really help you accelerate your profits, which is the fact that you need to realize that volatility is what you want to find and play, which is another way of saying that you need high volume on the bars at the bottom of the chart and a very fast moving tape if you really want to make money and have some very consistent gains. This kind of high volume is going to almost always come because of a catalyst like a PR, an earnings date, a merger vote, or any sort of macroeconomic news, but its momentum tends to last only during certain periods of the trading day. And these periods will also give you a very good edge if you want to consistently make profits day trading. These periods are 9:30 a.m. to 11 a.m. Eastern Standard Time and 2 p.m. to 4 p.m. Eastern Standard Time, because historically, during these times, there's more participation from hedge funds, institutions, and even other retail traders. If you have a closer look at the intraday chart on SPRT, you can see why exactly these periods work so well. As you can see, after market open from that 9:30 a.m. to that roughly 11 a.m. stretch, we had a very high volume spike and generally speaking, a lot of volatility that scalpers and day traders can take advantage of. As you can see, we kind of came down to this pre-market low of the range and also the pre-market high, which again, like I said, works extremely well if you have a lot of liquidity in pre-market, which is exactly what we had here. But as we went into the day and into the lunchtime period between 12 p.m. and roughly 2 p.m. Eastern Standard Time, you can see just how much low volatility there is and just how much little opportunity there is for day traders like us. If you get caught up in a volatility squeeze like this, where essentially there's really no action and no range or direction on the stock price, it can be really harmful for you because you can get caught up in stuff like this, which is essentially when there's not a lot of volume and short sellers will essentially take advantage and take out your stop losses. And they're able to do that because there's no volume from the buying side, which is exactly what has caused the stock to go up in the first place. And that is why I always recommend that day traders should really be trading in that 9:30 a.m. to 11 a.m. time frame, or anything from 2 p.m. to 4 p.m., which is until market close. And as you can see, if you came back to the desk after 2 p.m. EST, you would have had a lot of opportunities to take advantage of for either panic dip buying or even short selling because of all the volume that has come into the stock all of a sudden. So I hope this puts into perspective why exactly timeframes matter so much and why you want to really restrict your day trading if you really want to become a consistently profitable trader. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.